Recently, former Federal Reserve Chairman Ben Bernanke took a break from his very rigorous 7 to 8 figure speaking and consulting schedule with hedge funds and investment banks to opine on the job that the current Federal Reserve, the Jerome Powell Federal Reserve, is doing. So Ben Bernanke actually applauded the Fed, shocker, that the Fed is doing a good job being dovish, supplying things with liquidity to prevent problems. But this is creating moral hazard. This is creating even worse problems in the future with derivatives and credit and debt that cannot mathematically be paid back, and now we have a Ponzi scheme. But it should not be a surprise that as Federal Reserve chairmen leave, that they become more and more honest. Now, they're not always honest, but you do get grains of truth, especially from former Federal Reserve Chairman like Paul Volcker, who admitted in his memoirs that he should have manipulated the gold price when he was raising interest rates in the late 1970s and 1980 to prevent that big gold price spike. And Volcker was also candid and honest prior to his death. And now, more recently, in the last 2 or 3 years, former Fed Chairman Alan Greenspan is being very honest, I would say. And Greenspan, who a lot of gold bugs and Austrian school economists call a traitor because he should know better, Greenspan has actually been predicting much, much worse stagflation and has been warning people that they should own gold. So I think that's honest on Greenspan's part now over the last 2 or 3 years. And Greenspan is saying that worse stagflation is the best case scenario. Now, obviously, things could be much worse. There could be hyperinflation. There could be a debt deflation if it's temporarily allowed, like in 2008, briefly after Lehman Brothers failed. Although I think the probability of that happening, I think, is pretty low, but you never know. It depends. Maybe it's other companies in other industries, like an insurance company similar to AIG, or similar to what happened in February and March of 2020, where hedge funds doing the leveraged basis trade and the leveraged risk parity trade and the leveraged short volatility trade and all these leveraged trades, bets using bad collateral or counterparty risk, just crazy bets. And then these hedge funds were bailed out. Ben Bernanke actually has a history, if you go back a number of years, and I've been covering these in the past. So we'll talk about this briefly. Ben Bernanke actually in 2016, in a blog article for Brookings, he actually wrote that the Fed would eventually head to negative interest rate policy. And people like Carmen Reinhart and others have talked about financial repression and Japanification and stagflate tax lie, where there's nominal GDP growth and there's an attempt to create inflation because deflation will not be allowed. But one of the main reasons I actually did this short little video is because I wanted to talk about Ben Bernanke's op-ed column from November 5th, 2010 that he wrote for the Washington Post. And in there was actually a lot of truth nuggets hidden in there that people, if they have not read it, and I'll put the link below to either read or reread. And the paragraphs that I think are some of the most important are highlighted in the red section, and you might not be able to see them on your screen, but again, the link will be in the paragraph below the video, where Ben Bernanke promises that the QE program at the time, while it is unconventional at the time, and now it's conventional, will not increase the money supply. So it would not increase M1 and M2. And he said during that op-ed that if the money supply, if M1 and M2 started to spike very rapidly, that it would be very, very inflationary. But he promised that the QE programs would not do that. So the deflationistas are ignoring this. All you have to do sometimes is just go back and check and see where people from the Federal Reserve or former Fed chairmen are actually telling the truth, when they're not getting paid 7 or 8 figures in speaking fees after they leave the Fed, like Janet Yellen was prior to her being named as the new U.S. Treasury Secretary. Even when the Fed is in academia, they're still getting rich. I've covered this in the past, where Janet Yellen and her husband had about between 6 and 8 pensions between them. They were getting speaking fees. They're worth around $10 million total. And that was years ago. That was at least 3 or 4, maybe 5 years ago. So Janet Yellen's even richer than that now. Just ridiculous. So the main thing here is, if you go back and read Ben Bernanke's November 5th, 2010 talking about QE, promising that it would not increase the money supply. Well, now the money supply is increasing, and it's starting to affect commodity prices. It's starting to really piss off the U.S.'s creditors, the trading partners of the U.S. So you're starting to see all these countries that in the past that ran trade surpluses would have recycled those trade surpluses into U.S. Treasuries. They are not doing that. And that does not bode well for what the Federal Reserve is going to have to do with their balance sheet. And I would be shocked in the next 6 to 8 months if the gold price is not a lot higher. Let's just say that. The silver price is already starting to react with the stuff that's going on the Reddit boards and Discord after what happened with GameStop, but I would be absolutely shocked if the gold price is not a lot higher, along with the Federal Reserve's balance sheet. But I think at this point the gold price is very correlated to the Federal Reserve's balance sheet, and it's just waiting for the Fed's balance sheet to head to 8 trillion, then 9 trillion, then 10 trillion. And with the budget deficits that Joe Biden and a slight Democrat majority is planning, it's going to be that high. So I highly recommend that my listeners either read or reread Ben Bernanke's November 5th, 2010 op-ed. There is a lot of admissions in there about stuff that's happening now that Ben Bernanke said would be inflationary if it happened, promising it would not happen back in 2010, and now it's happening. So we're going to have, as a best case scenario, a lot worse stagflation. The government's probably not going to record it in the consumer price index. Unfortunately, it looks like Congress and Joe Biden are going to be raising taxes on a lot of different things, along with taxes at the state and government level. And this all fits into Japanification, financial repression, and stagflate tax lie. I really hope we don't go to negative interest rate policy, but you're starting to see in governments like the UK, it's even being talked about. The IMF has talked about it in the last 12 months. They've written a lot of papers. They're PhD economists. So unfortunately, these neo-Keynesians or Keynesians or MMT people, it seems that they're going to make every single stupid mistake and hit every branch all the way down the stupid tree.